Okay, started.
Okay, cool. Alright. So, in the actual mid-year, you still have options. So you know how it says here, define 2, you've been given 5, you've got to pick 2 that you know well. You still get the same thing, but in the actual list of questions you don't choose or which questions you want to pick, you just do the options within the question. There's only 2 now instead of 4. So, define 2 of the following terms. Well, we could do all of them because we're going to. Capital. What is capital? Yeah. Owner contributions. I'm also wanting you to tell me that it's equity. I want you to explain that out of the type of accounts, it's an equity account. Capital is owner contributions, and it could be cash, it could be assets, and it contributes to the overall success of the business. In actual fact, in the future, it can also be profit. And profit goes to capital later. What's an accrued revenue? First of all, it is a temporary asset. Always start by telling you the type of account that it is, which means that it has a debit nature. And what is it? What's accrued revenue mean? What's accrued mean? Owing. So it's revenue owed to us at balance date. It's currently not on our books, and we're accounting for it.
full sentences.
Oh yes, it does. I'm just summarising.
Oh, okay.
So if I was going to write that, I would say capital is an equity account that is credit in nature. It is owner contributions or in the form of possibly cash or assets. And if it's an existing business, that might also include profit. I'm just summarising the key points. Cost of goods sold. Follow the same process. What type of account is it? You can answer things.
An expense.
It is an expense. So what nature does it have? Debit in nature. It is the stock or materials purchased for resale, and that actual cost of goods sold account is used to record cost entries. A really elaborate answer might show that there is the sale entry that comes first, and for a trading entity, so a business that sells products instead of services, you can do both. A trading entity also has to do a cost entry after they record sales because they need to adjust their inventory on hand. GST credits received. In that one won't be on there because we don't separate it anymore. But as a side note, it's a liability, and in some ways it's contra because it's a credit we received for expenses paid. Credit received on GST paid. We might have paid for expenses or other assets in the course of running our business. That's not going to be an option though because GST is, we just call it collected, clearing now in total. Accounts receivable, what type of account is that?
Asset.
Yep, it's an asset, so it's debit in nature. And I define it, it is money owed by customers agreed to pay within usually 30 to 60 days. You might also say something about it being known as on account or something like that. That's my definition. It's money owed by customers and they agree to pay within a set date. So I'd pick 2 of those. I wouldn't have circle the ones that you know best and can write an answer for. But if I'm going to memorise how to respond, I should always say what type of account. First, that's the first step. What is its nature? Sometimes it's worth explaining that if it's debit, it's because it has a value to our business, whether it be that it's an ongoing non-current asset or it's an expense that contributes to the operation of our business. I could explain it as well, my fourth mark. Then I'm going to define it, the account name, and I could even give an example of an entry or a scenario where it's used. Part B is a little more tricky because it refers to some of the accounting assumptions. We need to know the difference between cash accounting and accrual. So there's a whole slide, a couple of slides on that in the balance day, what's it called? PowerPoint that we worked on, and there's one particular slide and it has cash versus accrual. Those are the answers to that question. So in a nutshell, a cash system, you recognise everything. When cash is received or paid. So we don't care if it's not earned or incurred within that period. We only care about the movement of cash. So if I paid something, then I record it. If I received cash, then I record it. There are no adjustments made for whether I deserve it or not for that period. Whatever fell in that financial year is in my report. On the other hand, accrual accounting is about what is earned or incurred in the period. And that's where we have the balance day adjustments coming in. The accruals, prepaids, accruals and prepaids are employed to apply. And this would be a clever answer if you refer to another principle to answer the question. You apply the matching principle. So you're matching revenues to expenses incurred. And in layman terms, that's just if I earned $1,000 in that financial year, hopefully more than that, then I'm going to work out exactly what expenses relate to earning that $1,000, which is why we have it was owed or incurred, and we add it in or subtract it from our books as it applies. Those balance day adjustments are used there. Let me just check how many marks are given for that question. So that's enough. Answer 3 questions and they're 4 marks each. That's enough. So each of these principles, you don't necessarily have to just stick to the principles it's asking for. A good answer will refer to the matching principle because that's the biggest difference between cash and accrual. One applies the matching principle to their revenue and expenses and the others doesn't. One just recognises once I receive a tax invoice and that money appears in my bank account. Next one, accounting entity assumption and the matching principle. So if you're smart, you actually look at that list to give you the answers for the others. But anyway, what's the accounting entity assumption?
That the owner's kept separate from the
Mhm.
business.
Yep. Owner separate from the business. Now remember, it's worth 4 marks, so I need to say about 2 things for both. What else can I say about the accounting entity assumption? How else does that apply?
We own separate from
Yep.
employees.
So we have capital and drawing accounts and their equity to track or record what we owe or have repaid, because drawings is like repaying the owner.
easy 2 marks there. I also might have said something about unlimited liability, or limited. I might have explained that even though we treat the owner separate to the business in our books, in reality he's not legally separate if he is a sole trader, because we operate in a sole trader environment for all of our scenarios. So in that case he still has unlimited liability for debts. We treat him separate just to track what we owe and have repaid him. Part of the accounting equation. On the other hand, what's the matching principle? I just talked about it before. I match revenues to expenses within a financial year or a period. It could be shorter, but we're making sure that the expenses incurred and the revenues earned match. So they occurred in the same time frame. And that's why we have accruals and prepaid, to get rid of the things that aren't incurred or owed in that time. So again, I could refer to accruals and prepayments. In this instance, I think it would make sense to give a scenario as well and talk about the fact that we could have an accrued revenue, which means we've done some work or sold a product and haven't been paid for it yet. So we're going to recognise it using the matching principle, which means I have to create an accrual or a prepayment entry. Current liability and non-current, this one's easy. First I need to define current and non-current. How do we define it? So it's going to be used, repaid or consumed, depending on what type of account it is, within a year is current. Non-current is that it's going to be used for more than one financial year, or we haven't repaid it within 1 year for a liability. So I'm going to explain that for a current liability, that means that I will be paying it off within a year. If it was a current asset, then I'm explaining that I'm going to use it within a year, or receive that money within a year. It's an accounts receivable. Non-current then means that it's a loan that extends further than this financial year. So I've categorised it as non-current, because I know I'm going to be paying it for more than this year. The difference between a service and a trading entity, that's a fancy way of saying one sells services and one sells products. So service, they provide services, and trading, they sell products. In reality, you can have a mix. You could do both. The biggest implication in accounting is that if it's a trading entity for an accountant, that means you have to have a sale entry and a cost entry. That's the distinction that they want you to make for accounting. That's one part of the answer, and that's the second part. You acknowledge there's more record keeping that happens in a trading entity, because we have to adjust our inventories every time we sell them, as well as recording the sale. Whereas a service business just has to say debit cash, credit sales, credit GST. We have to do a second entry to adjust our cost of goods sold and inventories. That's the difference on that one. The difference between a general ledger and a general journal, that's easy. In terms of the accounting cycles, I need to make sure I use all of those terms. The journal is where we record an entry after receiving a source document. So that might be a receipt, or I found a payment in my bank statement these days, more likely than a cheque. The second part is that I would have adjusted my ledger accounts by posting the accounts based on what entries are created in the journal. So everything comes through that flow, and the difference